In recent years, Cava has emerged as a true sensation, captivating not just food lovers but also the financial world. What started as a single Mediterranean eatery has rapidly transformed into a nationwide phenomenon, drawing crowds of hungry customers and the attention of sharp-eyed investors alike. The secret to Cava's popularity lies in its fresh, vibrant, and highly customizable Mediterranean bowls. Each bowl is a canvas, allowing diners to mix and match greens, grains, proteins, and a rainbow of toppings, creating a meal that's as healthy as it is delicious. This build-your-own-bowl approach has struck a chord with health-conscious eaters who crave both convenience and quality. Whether you're vegan, gluten-free, or just looking for a flavorful lunch, Cava's menu offers something for everyone, making it a go-to spot for a diverse crowd. Cava's explosive growth has been nothing short of remarkable. By acquiring and converting hundreds of Zoe's Kitchen locations, the brand was able to expand its footprint at lightning speed, establishing a national presence in just a few short years. This bold strategy allowed Cava to leapfrog many competitors and become a household name almost overnight. Such aggressive expansion didn't go unnoticed on Wall Street. In 2023, Cava made headlines with a blockbuster IPO, sending its stock soaring and fueling sky-high expectations among investors eager for the next big thing in fast casual dining. Many saw Cava as the next Chipotle, a brand poised to revolutionize the restaurant sector and deliver rapid, sustained growth. Its stock quickly became a symbol of optimism and high potential in the industry, with analysts and investors closely tracking every move. Cava's commitment to fresh ingredients, dietary inclusivity, and seamless digital ordering has helped it build a fiercely loyal customer base. The brand's tech-savvy approach, from mobile ordering to contactless pickup, has made it especially popular with younger diners who value both health and convenience. But with such rapid growth and high expectations comes significant risk. Investors know that any sign of slowing momentum or missed targets can trigger a sharp reaction in the market, putting immense pressure on the company to keep outperforming quarter after quarter. This week, Cava's story of seemingly unstoppable growth hit its first real speed bump. A dip in customer traffic and a less-than-stellar earnings report sent shockwaves through the market, raising questions about whether the brand can maintain its breakneck pace. The market's response was swift and unforgiving, underscoring just how much pressure is on Cava to keep delivering results. As the company faces its first major test, all eyes are on whether this Mediterranean sensation can continue to satisfy both its loyal fans and its demanding investors. Cava's stock took a nosedive this week, sending shockwaves through the market and leaving many investors scrambling to understand what went wrong. The Mediterranean fast casual chain, which had been riding high on optimism and rapid expansion, suddenly found itself at the center of a Wall Street sell-off. The trigger? Cava's second quarter results, which fell short of the lofty expectations set by analysts and investors alike. Hopes were high for another quarter of strong growth, but the numbers told a different story, leaving many shareholders disappointed and concerned about the company's future trajectory. The company's shares plunged over 20% in after-hours trading, a dramatic drop that continued a downward trend. In fact, Cava's stock has now fallen 40% this year, erasing much of the excitement that followed its initial public offering. The speed and scale of the decline caught even seasoned traders off guard. But the main culprit wasn't just a single disappointing number. Instead, it was a broader, more troubling signal. Cava's outlook for future growth had weakened. The company's management didn't just report a tough quarter. They suggested that the challenges might persist, raising questions about whether the company can maintain its rapid pace of expansion. Specifically, Cava lowered its guidance for a key growth metric that investors closely watch. This move signaled that the slowdown might not be a one-off event, but rather a sign of deeper issues. For a company that's been selling itself as a high-growth story, this was a major blow. For a growth stock like Cava, this is a red flag. Investors aren't just buying into current profits. They're betting on the company's ability to keep expanding, open new locations, and capture more market share. When that future potential is called into question, confidence can evaporate almost overnight. When a company dials back its own forecast, it doesn't just impact the numbers. It challenges the entire growth narrative that attracted investors in the first place. Suddenly, the story changes from one of unstoppable momentum to one of uncertainty and risk. the market responded swiftly, slashing Cava's valuation as confidence in its long-term story wavered. Billions of dollars in market cap were wiped out in a matter of hours, underscoring just how quickly sentiment can shift in today's fast-moving markets. This sharp reaction is a reminder of how volatile growth stocks can be, especially when expectations are sky-high. Investors and analysts alike are quick to reassess their outlook when a company stumbles, and the resulting volatility can be dramatic. For Cava, the challenge now is to prove that it can still deliver on its promise. The company will need to reassure investors that it has a plan to reignite growth, address operational challenges, and regain the trust of the market. Investors are watching closely for any signs of a turnaround, whether it's stronger sales, improved margins, or a compelling new strategy. The next few quarters will be critical for Cava as it works to restore confidence and prove that its growth story isn't over yet. Cava's second quarter report was a mixed bag, offering both reasons for optimism and a few red flags for investors to consider. The company, known for its fast casual Mediterranean cuisine, has been under the spotlight since its IPO, with Wall Street watching every number closely. The good news is that earnings per share came in at 16 cents, beating Wall Street's estimate of 13 cents. This outperformance on the bottom line signals that Cava is managing its costs well and finding ways to boost profitability, even in a challenging economic environment. Strong cost control and operational efficiency are clear highlights. The company's ability to keep expenses in check while still delivering quality service is a testament to its disciplined management and streamlined operations. However, not everything went according to plan. Revenue missed expectations, coming in at $280.6 million versus the anticipated $285.6 million. This shortfall, though seemingly minor, can have outsized effects on a company that's expected to grow rapidly. For a high-growth company like Cava, even a small revenue miss is a big deal. Investors are looking for consistent, robust top-line growth to justify premium valuations. Net income also dipped slightly year over year, from $19.7 million to $18.4 million. While not a dramatic decline, it does suggest that some pressures are weighing on the company's overall profitability. So, while Cava was more profitable per share, its overall profit pool shrank. This means that although the company is squeezing more profit out of each share, the total amount of profit available to shareholders is actually smaller than it was a year ago. In the world of growth stocks, missing on sales often overshadows an earnings beat. Investors tend to prioritize revenue growth as a sign of future potential, especially for companies still in expansion mode. Investors want to see the sales engine firing on all cylinders, with each quarter showing clear momentum and upward trajectory. Ultimately, the report raised concerns that Cava's explosive growth may be cooling off. As the company matures, it will need to find new ways to reignite excitement and keep its growth story alive in the eyes of investors. Wall Street's disappointment centered on Cava's same-store sales. Analysts expected 6.1% growth, but Cava delivered just 2.1%. This was a major letdown and the biggest shock in the report. The revenue miss, $5 million short, added to the concern. For a company built on rapid expansion, every million counts. The slowdown in same-store sales suggested Cava's momentum was fading faster than expected. While Cava beat earnings estimates through cost control, the market cares more about top-line growth. Investors saw a company managing expenses well, but struggling to drive customer spending. In high-growth stories, sales growth is king. The weak sales trends overshadowed any good news on profitability. The market wants proof that Cava can keep attracting new customers. Right now, that's in doubt. Same-store sales, or comps, are the gold standard for measuring a restaurant's true health. They show whether existing locations are attracting more customers or getting them to spend more. Cava's 2.1% growth isn't terrible, but it's a steep drop from last year's 14.4%. That sudden deceleration set off alarm bells. Wall Street looks for steady, organic growth, not just expansion from new stores. Flat customer traffic means the small sales gain came from higher prices, not more visitors. Sustainable growth depends on bringing in new customers, not just charging more. The sharp slowdown suggests Cava's explosive phase may be over. Investors worry the brand's novelty is fading or that competition is heating up. The pressure is on for Cava to reignite customer excitement. What caused the slowdown? Last year's launch of grilled steak was a blockbuster, driving huge traffic and sales. This year, Cava had to beat that tough comparison, and couldn't. The steak effect created a high bar that was nearly impossible to clear. As the anniversary of the steak launch passed, growth naturally slowed. While this explains some of the deceleration, it also exposes a risk relying on hit menu items for growth. With customer traffic flat, Cava needs its next big idea to keep momentum. Investors are watching to see if innovation can drive sustained excitement. Cava's challenges aren't unique. Fast casual rivals are struggling too. Inflation and economic uncertainty have consumers cutting back on dining out. Even Chipotle reported a rare 4% decline in same-store sales, signaling industry-wide softness. Sweetgreen also lowered its outlook and its stock took a hit. The entire sector is facing headwinds, not just Cava. This context doesn't excuse Cava's results, but it helps explain them. The era of easy growth is over. Now brands must fight for every customer. Cava's ability to adapt will be tested in a tougher market. Despite slowing sales, Cava's profitability remains a bright spot. Restaurant-level profit margins are expected to stay near 25%, top tier for the industry. This shows strong cost management and operational discipline. Cava is also investing in technology, like Hyphen's automated make line, to boost efficiency. Automation could speed up digital orders and free up staff for better customer service. Chipotle is betting on the same tech, signaling a broader industry shift. High margins and tech investments give Cava a solid foundation. The company is preparing for the future, even as it navigates current challenges. The next year will be a crucial test for Cava. The company must stabilize investor confidence and reset expectations. Menu innovation is key. Cava needs its next grilled steak to drive buzz and traffic. Operational efficiency and cost control will remain vital as the company expands. Automation investments could pay off, but results will take time. Same-store sales will be the most closely watched metric. The big question, is this just a growing pain or a sign of deeper issues? Cava still has strengths: a beloved brand, healthy food, and strong margins. Now it must prove it can deliver sustainable growth in a tougher market. The journey from Wall Street darling to lasting success is just beginning.